Today, the banks have their money tied up in another asset that's also not doing that well, and that would be commercial real estate. See, during a time when treasuries were paying you next to nothing and bank deposits barely paid you 1% if you were lucky, commercial real estate was booming because you could take a loan for 1 to 2% and go and buy a property that makes 3 to 5%. However, now that interest rates have increased, there is a problem. Commercial real estate values are plummeting, with Morgan Stanley previously having estimated that this segment of the market could decline by as much as 40%, which is the same magnitude as we saw during the 2008 financial crisis. Why is this such a bad deal for banks? Well, as CNN previously explained, US banks hold about $2.7 trillion in commercial real estate loans, and about 80% of that is held by smaller regional banks, the ones the US government has not classified as too big to fail. Now, unlike most residential real estate loans that you and I would get when going and buying a house, commercial real estate loans are only fixed for a short period of time, and then the interest rate resets after 3 to 7 years, kind of like the introductory rate financing of 2006. And according to the data firm Tripp, more than $2.2 trillion will come due between now and the end of 2027, and regional banks could have problems collecting on those loans. After all, commercial real estate values are almost entirely dependent on two factors: how much the property makes and how high interest rates are. As an example of this, just imagine that we have a $1 million building that makes $60,000 a year, which is a 6% return. If interest rates then decline to 1%, that building could sell for $1.5 million, or a 4% return, since you could borrow at 1% to make 3%. But if interest rates spike to 6%, that building could only be worth $666,000, or a 9% return, since you'd now have to borrow at a higher interest rate to make the same 3% profit.